My family got away for a short beach vacation last week. To my great disappointment, none of my three children enjoyed the sand and the surf. They were thoroughly confused as to why the water comes in from the ocean, then back out to the ocean. They look down on their feet, and it's going back and forth, back and forth, back and forth. But I'm not worried because they're all under 5, and in time, I will have them trained to love the ocean as much as I do. Fortunately, we weren't just locked into having the beach. There were several pools to enjoy, so the kids had plenty of options. And that made me think about the investment landscape today. For a while, you only had the beach, and these were the AI, Magnificent Seven, mega cap tech companies. Those are the companies that were driving all the return. But now, there seems to be more choices, at least for the moment. Since the lows of late 2022, the market has largely been running off of artificial intelligence. ChatGPT was announced around this time, and remember, this was also a time when many forecasters were calling for a recession. The economy, of course, failed to deliver that weakness at that time, and so the AI story remained center stage. With it, mega cap tech stocks with AI stories were able to command a premium. Now, another reason why these tech companies were able to soar, they were less immune to the Federal Reserve's rate hikes. Just like wealthy households, these large, wealthy companies were less in need of borrowing money to fuel their growth. So rate hikes pushed money towards these companies that may have gone to companies in the rest of the market. Now that story may be changing a bit. The Fed seems poised to start reducing rates in September as long as inflation continues to cool. That should mean reduced pressure for smaller companies in the market and more investor enthusiasm for their stocks. So now these areas that have badly underperformed the market are starting to outperform. You can see that reflected in 2 areas in the market. Take a look at this chart. It's showing you value stocks shown using the VTV index fund, and then small cap stocks as reflected in the IWM index fund. You can see the two have vastly outperformed both the NASDAQ and the S&P 500 in recent days. This is great to see as a long-term investor. The rising market is more sustainable if more companies are in play. It's only been a week or so, but this broadening is encouraging. Right now, the market seems to be excited that the Fed is actually going to be able to cut rates into a strong economy. It supports the soft landing narrative. Just a little retuning of rates and the economy can continue marching upward. Yes, the unemployment rate has ticked up in recent months and jobless claims, they're on the rise as well, but neither is showing recessionary warnings just yet. They more closely resemble the normalization to the pre-COVID period. If the labor market does deteriorate more rapidly, the Fed will likely be forced to cut more aggressively, and the market's reaction will likely be far more pessimistic. But for now, take the good news. The market broadening is making diversification feel good again, and that's a good thing. Too much return from too few companies forces investors to throw caution to the wind and take too much of a concentrated risk. If that's you, hopefully the past week or so is helping realign your thinking to the benefits of diversification. Successful investing for most people I've talked with over the years is simply this: achieving their financial goals with the least amount of risk possible. That's also our goal as we help our clients navigate their investment journey.